My name is Elridge, and I own and manage a $2 million private money lending portfolio through our company Vertical Capital. Inside this portfolio, we actively implement the infinite banking strategy, or some may call it the infinite banking concept, but not in the way most people talk about it. Today, I'm going to show you how to implement the infinite banking concept without a whole life insurance policy. That's right. This strategy still works even if you choose to use other financial tools. And by the end of this video, I'll show you exactly how we're doing it inside our lending portfolio. So what is infinite banking? Let's start with the basics. The infinite banking concept, often referred to as IBC, is a personal financing strategy founded by Nelson Nash, the author of Becoming Your Own Banker. At its core, infinite banking is the process of becoming your own source of financing. Rather than relying on banks, credit cards, or lenders, you use your own capital to fund your financial needs and then pay yourself back with interest. Traditionally, this strategy is tied to a whole life insurance policy. You build up the cash value inside the policy, you borrow against the cash value when needed, and you repay yourself back with interest. At its foundation, infinite banking is not about insurance. Infinite banking is about replacing all of the finance functions in your life with your own banking system, your own bank. That includes funding purchases like your cars, real estate, investments, education, even vacations, all with your own capital. Let's look at why this is such a powerful strategy. According to different research, economic research, and also reading this book, the average American spends 34.5% of their income on interest alone. That's interest on mortgages, car loans, credit cards, student loans, you name it. Now ask yourself, what would happen if you could recapture even a portion of the 34.5%? You would build wealth automatically without changing your lifestyle, not by working harder or earning more, but by simply rerouting the flow of money back to yourself. Imagine paying off your mortgage, but instead of paying a bank, you are paying your own bank. You're keeping the interest and building your net worth in the process. If you are in real estate like I am, this gets even more powerful. What if you held a mortgage on every one of your rental properties? You would not only collect rent, you will also collect the mortgage payments. This is true velocity. This is banking. Let's shift from the concept to the actual structure. There are three buckets money flows through. You have the earn it bucket, the hold it bucket, and the spend it bucket. Most people focus on the earning and the spending buckets. They work a job or run a business to earn income. Then they use the income to pay for expenses like mortgages, food, gas, bills, etc. But very few people think deeply about the hold it bucket. And this is where infinite banking lives. So let's unpack that a little bit. Your hold it bucket is where your money resides before you spend it. It could be a checking account, a high yield savings account, a brokerage account, a retirement account, 401k IRA, a piggy bank, a safe or vault, a life insurance policy like your whole life, your IUL, even cash under your mattress. It could be in the hold it bucket. All of these are simply places to store your money. Some are more efficient than others, some are safer, some are more flexible, but they all serve the same core function. They're the holding tanks for your financing system. So which ones are best for infinite banking? Let's take a closer look at the popular options. You have a checking account. Some of the pros of a checking account is the liquidity. You can access the money instantly. It's FDIC insured up to $250,000. It have wiring and check writing capabilities. Some of the cons of a checking account is money can't be in two places at once, and the interest earnings are low. It's often below inflation. Number two, you have a brokerage account. At Vertical Capital, we use M1. And some of the pros of a brokerage account is liquid. The money can be in two places. It earns interest in the brokerage account, and we could borrow against the portfolio and lend it out through vertical capital and earn interest elsewhere. With margin loans, you are borrowing at 6.25% currently with M1, and you can lend it out, what we do with vertical capital, at 13%. It has wiring capabilities as well. Some of the cons of a brokerage account is that margin loans do come with risks if the value in your portfolio falls. It's a taxable environment as well. Number 3, you have an index universal life insurance. Some of the pros is in a tax advantage environment. You have a debt benefit. The policy builds cash value over time. Returns are tied to the market index up to 9.25%, and loans against cash value is typically 5%. And the money could be in 2 places, and you have wiring capabilities as well. Some of the cons: complex structure. Must be properly structured is most important to maximize the cash value early. Number 4, whole life insurance policy. Some of the pros is a tax advantage environment, is a dividend paying policy. You have a debt benefit. You could borrow against the policy. It's liquid. Money could grow and be accessed simultaneously, so it could be in 2 places. Some of the cons: it requires time to build up significant cash value, often misunderstood and misused. Number 5, you have retirement accounts, 401k, IRA. Some of the pros of a retirement account is a tax-deferred and tax-free growth, can hold title to certain assets. It's a long-term wealth builder. Some of the cons: penalties for early withdrawal, limited liquidity, less flexible in banking applications. The banking function is the most important part in infinite banking. Here's what most people teaching the infinite banking concept get wrong. They focus too much on the hold it bucket, especially on the life insurance policy, specifically the whole life policy. They emphasize things like dividend rates, index caps, and policy riders, but that's not the most important part. Banking is an action. It is a verb. It requires lending. If you're not lending money, you're not actually doing infinite banking. You're just storing money. Let me say that again. Infinite banking is only real when you lend your capital and recapture interest. So let's talk about the banking function, which is the most important part of infinite banking. The first step in order to build your banking system, you must capitalize your bank. This means funding your bank, whether that's a brokerage account, an IUL, or other holded vehicles, so that you can lend from it. People often say you need to have a high premium to build cash value. What they mean is you need to capitalize your bank. At Vertical Capital, we capitalize 2 holding vehicles. We capitalize our IUL policy and our M1 brokerage account. Let me walk you through exactly how we use the M1 account to execute infinite banking. Our strategy in action: each month, we contribute $1,500 to our M1 brokerage account. This is us capitalizing our bank. This is the capitalization phase. From there, we borrow against the portfolio at an interest rate of 6.25%. That borrowed money is then lent through vertical capital at a rate of 13%. Here's the math: borrow at 6.25%, lend at 13%. That's a 6.75% arbitrage or spread. But it gets better. We treat the brokerage account as a capital partner. It's important to separate yourself from your investments. Here's the breakdown. The brokerage account receives a 10% return on the capital it supplies. Vertical capital retains the 3% spread. Both parties win. The capital grows and the lending portfolio grows. This is the velocity of money in action. This is infinite banking without a whole life policy. And this is how you can take control of your cash flow. If I'm adding any value, subscribe to the channel. Help us get to 1,000 subs. Anitra and I truly appreciate your support. You could also apply this concept to your personal finances. Let's say you're buying a car. Instead of taking out a loan from a bank, what if you bought the car outright using your own capital and then made monthly payments back to your own bank? The payments you would have made on your car note to another lender, now you're making those payments to your own bank. This strategy works for anything: cars, appliances, travel, education. As long as you follow one key principle: you must be an honest banker. You have to pay yourself back with interest consistently so your bank can grow and serve you again. If this concept resonates with you and you want guidance and accountability, I invite you to join our free finance community. Inside, we focus on building your banking system step by step. We provide spreadsheets, tools, and frameworks to help you implement this strategy in real time. Guys, it's free. Just click the link in the description. Remember, you don't need a whole life policy to perform infinite banking. You do need a disciplined system, and most importantly, you must be willing to lend and recapture interest. And this is how you shift from consumer to creator, from borrower to banker. Thanks for watching. I'll see you on the next video.